Biogen may have finally discovered a somewhat effective treatment for Alzheimer's, but Wall Street's reaction implies investors are perhaps too skeptical. The biotech firm and its partner, Japan's Eisai, said the drug delayed progression of disease by 27% at 18 months in early-stage patients, and that news was enough to send Biogen's market value up by about $11 billion. Yet that reaction seems rather conservative. Consider there are about 1.5 million Americans in the early stage of disease, the number of patients is rising, there are a lot more patients overseas, and disease is both awful and progressive. While Biogen's drug is hardly a cure, the therapy at least appears better than none. Okay, now there's some good reasons for skepticism. The underlying data hasn't yet been released, and that data could contain unpleasant surprises. And even if the drug is approved, insurers and governments may not pay if they think benefits aren't worth the cost. But consider this. While the companies haven't announced a price, assume the drug sells for about $20,000 a year after discounts to insurers and the likes. If around 20% of Americans in the early stage of the disease take the drug, that would be about $6 billion of annual sale and resulting profit to be split between the two drug firms. Put the revenue on the same multiple as other pharma firms, and this is worth perhaps $15 billion to both Biogen and Eisai investors. Yet Biogen's stock only rose $11 billion. So investors are probably assuming far fewer patients end up on the drug. There's a reasonable chance the drug and Biogen's stock may outperform these cautious assumptions.